and welcome to Sector Wrap, an initiative by ICICIdirect. Today we're going to talk about two important sectors. One is telecom and the other is capital goods. Let's first speak on capital goods, and to talk on capital goods sector, I have with me a very special guest, Mr. Chirag Shah, Senior Analyst, ICICIdirect. Welcome, Mr. Shah.
Yeah, hi. Thanks, Geetu.
Mr. Shah, with economy recovering, the supply side constraints are also easing out. Labor situation is also, better from the COVID times now. What is your expectation from this sector? Are you really optimistic now?
See, capital goods have been a quite notorious sector in terms of predicting the structural up move in this sector over the past decade. Because see, if you see India's history in terms of a Capex cycle or a sustained manufacturing cycle, we never had experienced any sustained Capex cycle for a period of more than, say, 1 or 2 years, barring the fact that from 2003 to 2008, we had one sustained capital or infrastructure cycle, to say so. But post that, 12 years have gone by, and whenever we had a decent start and we were about to see an uptick in the Capex cycle, some unforeseen event like a demon or a GST implementation or the recent COVID pandemic struck, and probably the cycle went down in for a toss, and again we had to start from scratch. So, but given this time, the way the government is taking measures, number one, when the pandemic had kicked in, we realized that we have to be a domestic-oriented economy, dependent on our own manufacturing base rather than importing things, because India has been a net importer across all the major categories, and capital good is no exception to it. So one realization on that side led to the birth of the PLI schemes, and PLI schemes across various sectors like auto, textile, mobile manufacturing, so as not to only bridge the export-import gap, but to also become an export hub for the globe. And in that case, probably that is a very big foundation for the Capex cycle to kick in, because once you invite all the global companies out there to set up manufacturing bases, so that will lead to a multiplier impact on the economy in terms of creation of the infrastructure cycle. And not only it will impact capital goods positively, but also have a multiplier effect in terms of incremental demand for cement, steel, and other ancillary products, which again will create opportunities for capital good companies in creating new capacities to cater to such demand of steel and cement, which will arise from such kind of a demand environment. So yes, if things pan out the way they have been projected, yes, we are at the cusp of a new Capex cycle, which India has been wanting over the last decade. But as the unforeseen circumstances have come, we could not see an uptick or a continuation of the same. In the medium term, yes, if you look at the first half of this particular fiscal, we thought that FY21 would be a disaster years for the capital good companies, because H1 and it was a complete washout in terms of revenue bookings, because there was good amount of labor shortages and projects were not being able to execute on account of lockdown and no movement of goods and people from one place to another. And secondly, there was literally a lull in terms of order inflows. But again, Q3 or end of September, things took us by a surprise when we saw a huge amount of tendering activities lining up, more particularly from the government side. So if I just connect the dots of the intention of the government to create a sustained infra cycle in order to achieve a double-digit sustainable GDP growth rate, and the kind of schemes that they have come up in terms of PLI or creating our own manufacturing base, probably we are at the cusp of a new cycle. And unless we don't see a second harsh wave of COVID or any other unforeseen circumstances. And the Q3 results that have come by have surprised to us on the positive side, given we were expecting a decent amount of deceleration in terms of execution, but that was not the case. Order inflows, as I mentioned, that let us take an example of a company called like an L&T, which is the mother of, or probably the right barometer for judging the capital goods sector. Announcing orders in excess of 73,000 odd crores was a whooping number, and nobody would have expected in such an environment, company like an L&T can garner such a big number during a quarter, which was supposed to be a near washout kind of a thing. So things are really picking up, and then came the budget, which again was a quite no-nonsense budget, sticking to the quite prerogative of the government that yes, if you want to grow at 9-10% GDP, infrastructure is the way to take the GDP out there. So infrastructure would be the key vehicle or the catalyst for getting the growth back into the economy. And the way the allocation has been done, a 26% jump in capital expenditure across all the key segments driven by the government, again points to the fact that yes, they want to kickstart the infra cycle and push the growth for the economy. So we have actually turned positive on the sector per se, and probably in the medium term, we like more of product-based companies than an EPC-based companies, because EPC-based companies, yes, they will have opportunities, but they do have their own set of challenges. So unless we get into a midterm kind of a cycle wherein we are convinced, yes, the cycle has begun and we are at the middle point, probably we would prefer product-based capital good companies versus an EPC-based companies.
If we talk about capital expenditure, it has been the government expenditure which has been on the rise, but private companies have not been really, putting in money for capital expenditure. What do you have to say? I mean, if you are so optimistic about the policies which have been announced by the government and that will really give a boost to this capital goods sector, do you expect the private investment to really, kick off from here?
See, private investment will come in pockets. The clear reason for the same is if you look at the excess of 2008 cycle, corporates had made huge mistakes in terms of bidding the projects in terms of economic viability, and that is the pain that they are still suffering till now. And many of those players are still not existing. They have gone down the hill and probably they've filed for bankruptcy. So many of the players in the sectors have already gone out, and many those who have survived are still clearing their balance sheets or amending their business, the way of doing business. So probably it is the government which has driven the Capex level whatsoever in the last 10 years, and going ahead, at least for the next 3 to 4 years, if you see, it will be the government related sectors which will drive Capex. Because if you see, the major multiplier effect will come from sectors like roads, railways, renewable energy, urban infrastructure. So these are, in any economy or any cycle, if you see this, all sectors are dominated by government agencies or government companies. So private sectors will have a role to play, but it will be very limited and in pockets. Say sectors like steel or cement, where the market share of private sector companies are high and they're doing pretty well and the balance sheets are in a pretty decent shape, probably you will see those segments wherein private sectors will come up and put Capex. Otherwise, at least for the next 3, 4, 5 years, it will be the government which will drive the Capex cycle in India.
If we talk about the budget announcement, do you think enough has been done, or do you expect something more to come for the infrastructure sector that will really give boost to the capital goods sector in turn?
See, Geetu, you have to connect the dots between the optical fiscal deficit number that the government has put and the kind of expenditure rise the Capex segment has seen. If you look at the overall the revenue expenditure is almost flattish on a year-to-year basis. And what has got a fillip is the capital expenditure. If you see in number of percentage terms, the growth that the government has given is 26% growth on the capital expenditure side, vis-a-vis the revenue expenditure remaining flat. And the kind of deficit that the government has expected, a number of 9.5 for this year and 6.8 for the next year, the incremental deficit will be going towards funding the incremental infrastructure creation. So probably we believe everything might not happen this year because things take time, and particularly in an economic like India, and when you are coming out of a pandemic kind of a situation. But yes, the tone is almost right. If you look at the commentaries of the companies, for example, there are small material handling and construction equipment companies. Over my career, I've never heard them so bullish the way they are sounding it like right now. So they have a clear visibility of at least next 2 to 3 years of clocking their revenue growth in double-digit rate, which was never the case. So let's hope, keep our fingers crossed, and this growth actually pans out the way they are forecasting it.
Chirag, your view on EPC versus product companies?
See, on a generic basis, EPC companies do have a good amount of, I would say, a foundation or a growth area. But again, the challenge out there is the working capital. For a capital good EPC company, working capital is the most important criteria. And the way we have seen in past, most of the companies could not manage their projects well, or they got stuck in the entire value chain for some reason or the other, maybe not their fault at all. But again, the price was paid by them. So working capital management is a big challenge. So unless we don't have 2-3 years of good bounce in the capital goods segment, probably we would prefer product-based capital good companies because the orders or the execution timeline are quite small. The revenue booking is not that lumpy. It's quite even across all the sectors. They have a decent amount of replacement segment also there. So if the OEM segment goes down, probably replacement sector can cushion to some extent in a bad year. And secondly, most of the product-based capital good companies are almost having a debt-free balance sheet. So if say 2-3 years of bad time, probably they won't go down. They might not produce growth, but again, they will survive, and they will survive to see the next cycle if it's there. Unlike the case of an EPC company. So that is why we we probably favor more product-based capital good companies. And even historically, if you see in terms of valuation multiples, product-based companies do trade at a premium compared to an EPC companies because of the challenges that I've discussed with you.
What kind of opportunities do you see in automation and digitization field?
So as I already mentioned, that government is quite harping on the PLI schemes to come in. And the way industries are shaping up globally with a huge amount of disruption taking place technologically. So Industrial Revolution 4.2 is inevitable. And if you look at the global automation or digitization, industrial digitization market, it runs into billions of dollars compared to what India has. If you look at the Indian market, it's currently at about 41,000 odd crores, and probably is just 1.5% of the global industry size. So you can just imagine we are just a drop in the ocean, in a very big ocean. So we have a lot of ground to cover, and probably the way things are moving up and way competition is coming in across all segments, and the way we need to probably improve our throughput and plan properly, probably automation and digitization would be the need of the hour. And probably there are certain companies which have very decent product portfolios like Siemens or an ABBs of the world, which have a great product portfolio backed by their strong parentage. So they have a mammoth kind of opportunities in this particular segment. I'll give you an example. Recently, Ola has announced putting up a electric vehicle factory in India. So the orders that have gone to Siemens and ABB. So Siemens has bagged an order to create what is called a digital twin. So now what does this digital twin does? It creates a virtual reality for the company to imagine how the products would look like without creating the actual prototypes or manufacturing the actual prototypes, so that they can well in advance be prepared what kind of production planning, what kind of value chain of automation and digitization would do to the total capital goods industry. And the opportunity is mammoth across all the verticals.
Chirag, rising commodity prices, rising freight prices, is it a concern for capital good companies? And if it is, what kind of impact do you see on their margins because of these things happening?
See, you have to classify the input cost rise into two buckets. The most important raw material is steel, which no capital goods companies can hedge because there are no actively traded steel futures across the globe. Other commodities like copper, aluminum, you can trade. So what the best practices these companies adopt is whenever they get an order, so they know the timing of the material and the quantum of the material that will be required at a certain milestone of the project. And they enter into a back-to-back agreement for the raw materials required. So in case of, except steel, they are quite hedged. But in case of steel, yes, there will be a medium-term pressure. But again, to offset that, again, on a case-to-case basis, many companies do operate on a model which is known as a price-to-variation clause model. All orders which the companies win have a price-to-variation clause inbuilt in them. So if a commodity rises by an X percentage, over and above an X percentage of inflation, then you get the offset for them. Yes, it will be an intermediate challenge, but then again, the dynamics would set in, and probably given the back-to-back arrangements the company do, they will kind of price in the elements and probably put their bids going ahead.
So you don't expect the margins to be dented? Yeah?
It will be, but not much. So it again also depends on the efficiency of the company. How do you operate? So if you are a company like an L&T, which does a good amount of bulk buying, you have your own set of advantages compared to peers.
What are your top picks, Chirag, if we talk about capital goods space, both in the top rung stocks and the mid cap and small?
See, again, I would not go in terms of market capitalization. I would rather prefer to keep it two baskets of EPC-based companies and product-based companies. So in EPC-based companies, probably our top pick would be Larsen and Toubro and Bharat Electronics. While Larsen and Toubro, again, if you look at the breadth on the length and breadth of the operations in terms of geography, in terms of kind of verticals it caters to, in kind of the technology or kind of the prowess it has in terms of execution projects, it is no doubt the best play to play the Capex recovery cycle in India. Secondly, if you see they historically, if you look at from 2010 to 2015, they had made their fair share of mistakes in terms of bidding BOT projects, which was never their cup of tea. So now they have accepted their mistakes. The management is walking the talk. They are trying to lighten the balance sheet. No more BOT projects. The complete focus is on creating ROEs, winning profitable orders, maintaining a reasonable threshold level of margins, and secondly, to grow their services portfolio. If you look at the IT services portfolio of the conglomerate, it has been doing tremendously well. So if I can give you an example. When they had acquired Mindtree, they had acquired for a value of 10,000 odd crores, and in a period of 2 to 3 years, that 10,000 crores stake has become almost 20,000 odd crores. So they have created a decent amount of value of the overall IT portfolio. So probably all cylinders are firing for them, and I believe if the Capex cycle turns out what we are anticipating, then there could be a huge amount of re-rating and earnings upgrade for the company. Secondly, in the EPC space, we like a defense space, as I already mentioned, Bharat Electronics. It's it can grow at 10-15% kind of a growth rate, given the kind of order backlog and visibility it has. It commands one of the best margins across all the defense PSUs. It has a margin in excess of 17 to 18 odd percent and a debt-free balance sheet. And compared to other defense PSUs, his execution cycle is not that lumpy or chunky as compared to other guys. So Bharat Electronics is another bet in the EPC space. Coming to the product-based companies, as I said, we are quite bullish on construction equipment space. So there is a small cap company called Action Construction Equipment. They are pretty much quite leaders in their own segments in which they operate in. So probably that segment can grow at least 15-20 odd percent. And there are 2-3 more smaller segments that they have done, and they have not done that great. And probably we feel that the time has come that segments can be scalable easily at say 30-40% kind of growth rate over the next 2 years. And being a debt-free balance sheet, if they execute on what the management is talking about, probably there can be a huge amount of re-rating in this stock. Mm-hmm. On the product side, again, we like a company called SKF India. So these are all natural beneficiaries of a Capex cycle playing out. So when you have a industrial Capex cycle playing out, these companies do get their fair share of business earlier when compared to an EPC business. So SKF again is a leader in the bearings market in India. And probably we believe that industrial segment, which is a low margin segment for them, if it fires up, depending on the Capex cycle, probably there can be a huge amount of margin revision upwards and hence a good amount of re-rating and catching up with its peers. So these are the top stocks that we believe can be played upon in the capital goods space.
Thank you, Chirag, for being with us. Thank you for your time.
Thanks a lot, Gitu.
Now let's talk about telecom sector. And to talk on this sector, I have with me a very special guest, Mr. Bhupendra Tiwary, Lead Analyst Telecom, ICICIdirect. Welcome, Mr. Tiwary.
Thank you, Gitu.
Bhupendra, let's talk about telecom space. When we talk about telecom space, everybody the last 2-3 years has been talking about the worst is over for telecom companies. The worst is over. Do you really think the worst is over now?
Yeah, so basically, we just walk through what has happened. So if we kind of go back 5 years back, we're looking at a sector with 8 to 10 players every circle, and with nobody having a pricing power. There was this, it was basically a voice kind of a play. And then, of course, it coincided with two facts. One, that 4G came, which was basically a database network. And second is that a new entrant called Geo came. And everybody knows how the pricing were democratized, if we can call it. But what happened is that the whole data consumption took off. We're looking at a sector where the data usage is upwards of 12-13 GB per month on an average, as reported by these players. And what it does is that the uptrading theme kind of takes place. So from when you kind of mature from a voice-only users to a data user, of course there is the second leg that which already happened a year and a half back, when they took first round of price hike of around 20-25%. Then when we talk about this sector now, it's the three-player sectors. So, at least the pricing control or the risk of price disruption is less. And we haven't seen any price cut prima facie, any major price cut prima facie when we say into this sector. So taking into all this account, the whole sector structure has kind of changed positive. So in that sense, yes, things have changed, and we say worst is over. Now the key question is, are we into the best zone yet, and how will the best thing play out? So that should be the key question.
Okay. Telecom data usage, as you spoke about, has increased sharply in last 1 year. What is your reading on the sector, and how is it going to pan out? With digitization being the key, and in COVID times, we have shifted all to the digital platforms.
Yeah, you rightly said. So, telecom truly found opportunity in adversity, I would say. So what happened is that the data kind of kicked off. So the data usage has doubled, if I say, from the last 5-6 quarters. Now, what has driven this? So first is work from home culture. There is the edtech usage, which is happening at home. So most of the kids are studying back home. They're not going to school. And third is the OTT video usage. And we must understand the major usage of the internet in India happens through OTT video. So these three things have driven it. The ARPUs, of course, with the price hike and the natural upgrades have kind of risen up. So you're looking at ARPUs at around 20-25% higher than what they were 5-6 quarters back. So these are the two things which played well. There have been no major cost kind of a pressure. Of course, in terms of the operating costs and all those things, so that has also aided. So operating leverage has seen, most of the telcos have seen margins expansion. So we have gotten into a zone where now the question is, how do we get the pricing higher to make the ROCs make a business case out of the ROCs? Now, what we need to appreciate that even the leader doesn't have a double-digit ROC right now because of the amount of Capex that has been put in. And only way to kind of get these ROCs is, to get price hike. Of course, on the longer term horizon, we can delve into the 5G use cases, which will be a B2B network. Of course, the use cases of security services or say smart factory or smart car, all those usages will come up, smart metering and all those things, and all those revenues will accrue to the telcos. But we're talking about 5 to 10 years down the line, those business use cases have to develop sharply. Now, in the recent time, what can lead them there? Of course, they have been talking about this, a minimum ARPU of at least 200 in the near term, so as to get a meaningful business out of it. And that's what we see, and that's where we should go. You also talked about it, so and that's what we are waiting. Rather, we would say in terms of the price hike. The trigger per se, that's something that has to be seen.
Yeah, actually, as you said, we have just 3 players left in the telecom space now. The competition is fierce. Everybody is, really fighting for the market share. So in this market fight for the market share, they are losing on the tariff ground. Like, there's a saying that who will bell the cat first. Everybody is waiting, like who will raise the tariff first. Everybody is now inching towards garnering and gaining the market share. How long will it last? Is the tariff hike imminent? Will it really happen?
Okay, so the answer to the second question is yes, it will happen. Now, the second thing is the timing of it. Now, 2-3 things. Now, look at the player-wise. What is the need for the tariff hike? So, for Voda Idea, tariff hike is need for survival. It has to raise the tariff in order to meet its, debt and interest component, and in order to survive, in order to make a good business case. Right now, it is under debt. Right. Second is what is the need for tariff hike for an Airtel? Airtel is still it's been doing pretty well than the peers, but still, in order to make a decent ROCs business out of it, it has to make a 200 kind of an RO that we're talking about. The third is the nuclear, which is, I think, apart from the business case out of it, if Jio has to go to the public market for an IPO, say a year or 2 years down the line, it has to show itself as a most financially viable player also in terms Of course, it is number one in terms of subscriber, in terms of the revenue market. So we're looking at a subscriber market, active subscriber market share of 33-34%, revenue market share of 40+% for Jio. But still, the ROCs are still high single digit and not the double digit. So it has to make it. Now, what is stopping it? Of course, let's go back 6 months back. For the last 6 months, we haven't seen Jio being, number one in terms of the active net subscriber ad. What has happened is that Airtel has been leader there.
Right.
There's been one or two reasons. One is the base has kicked in. Second is, we have to remember that Jio phone users completed 3 years sometime in September, October. And it was the lock-in period was close to 3 years, is what, if I understand correctly.
Right.
So those renewals, would have started to come in, and there would have been some drop-offs and all those things. So net impact has not been so good for. Having said that, I think keeping the longer picture in perspective, and we are hearing, and like the company has said, that it will come with some affordable smartphone also. So I think when they are kind of moving at an upgraded kind of a customer base rather than the pure Jio phone focus, I think ARPU will be the area where they will think into. Last we've heard is that Voda has kind of looking to do it by June. I think timing is anybody's good guess, but I believe we are at least into a few months down the line where even Jio would kind of agree, because I think these three guys have to come in tandem to make any hike. Of course, we also need to understand that there will not be a very steep kind of a hike at one go. It has to be a hike which has to be absorbed, which takes again 1.5 years. So last hike had been around 1.5 years. So I think we are entering into a zone where you'll see tariff hikes taking in. The quantum and the timing is something that.
Bhupendra, what is the next big challenge and catalyst for this sector?
All right, so catalyst, and I would say is for the longer term, is the 5G use cases. It's far, but the opportunity is immense. Imagine a telecom player having a customer base of 30+ crore. I'm talking about the top two players, and they have also the base of close to 2 crore plus kind of houses, so they can get into smart metering, smart houses, smart cars, and they are the one who have then access to your most of the services that you do over digital. So we're looking at a pure B2B and B2C case opportunity of monetization in a huge way. Something that we do not price in as a pure B2C companies. We do not look at it in terms of the ARPUs. It will be something which will be, largely annual kind of annuity kind of revenue that will start kicking in once these things start. So that is the big opportunity over the next 5 to 10 years. The Capex, yes, the Capex is one thing that has to be seen. We will also notice that. But having said that, we believe that it's a 5 to 10 year cycle, and this is where we are moving into. I think that will make telecom sector a pure, different from what we have been traditionally seeing as a B2C ARPU and per month kind of customer, somebody who's using data something. If you are into the part of the lives, I think the monetization possibilities is pretty huge there. Like I said, the challenge, I think challenge will be steering. The challenges are different for these three companies. I think for Voda, I said the challenge is to survive. The survival has to be a function of 2-3 things. Now the survival, number one survival thing has to come from the fundraising that they need. Second will be the tariff hike. Similarly, challenge for the Airtel will be to continue this, momentum of having higher subscriber addition, or the higher ARPU growth that it has shown so far. You see, the natural upgrades will continue to happen, and they will get some ARPU growth. But to be a leader and to maintain it will be the second challenge. And like I said, Jio has hit the roof in terms of subscriber share and all those things. Now here, I think profitability and the return ratios improvement will be their challenge. And I think and everything and all these three things connect to a dot, which is the tariff hike. So there is where we are leading.
Yeah. Your top pick among these three companies?
Yeah. So we prefer Airtel, which is a pure play on a telecom sector. So of course, Jio is the leader and has a strong metric, but it's the subsidiary of Reliance, which has a various business. So being a pure play business, and of course, we would like to have that company also as a player whenever it comes to list. But Airtel is a leading our top pick. Few factors are it commands a premium in terms of ARPU, a clear 10% premium, which we believe is here to stay. It has a strong customer retention and as well as customer net adds that I talked about 6 months. It has clearly beaten this. The other element of Airtel is being undervalued, we believe. Say, for example, the enterprise part of it, or an Airtel Money that they have there in Africa. The Africa business has turned around. It is throwing FCF over now. So these and of course the tower which again hinges on the possibility of how Vodafone does there. So these three things, apart from the tower challenge, I think most of the elements of the business are doing pretty well for Airtel. It has shown the same in terms of execution, and we see no reason that Airtel will not be a clear winner if once the tariff hike kind of pushes the ROCs to back to the double digits, and that's where we see the value structure.
Bhupendra, now Q4 earnings are around the corner. What is your expectation for the telecom space?
So while we have not zeroed down, but I'll give you a broad segment broad thing which will happen, which is different from what will happen. So this quarter, IUC has gone zero, which means so basically most of the companies account for IUC's revenues as a part of their revenues, and IUC's cost is also part of a cost. So although at the EBITDA level for a company like Airtel, I think it is a neutral at IUC level. So there will be no impact at EBITDA level. But you will see 7-8% kind of a decline in terms of the ARPU because of the IUC. Like to like basis, it will show some growth. So net 5-6% kind of a decline should be seen in ARPU of Airtel. Of course, the EBITDA will be same. So EBITDA margin will kind of show improvement QOQ, sharp improvement QOQ. That's one reading of it. I think natural upgrades will happen, which will add, So like to like ARPU growth is around 2-3% is what we expect for both Airtel and Voda. But the reported numbers will be 5-7% decline, 5% decline for say Airtel and 7% for this. Similarly, Vodafone, so it had a negative impact on this EBITDA because of this IUC. It was a net payer. So because it is going off, it will be a beneficiary by 80 odd crore per quarter is what I believe. So reported print will be quite different, but adjusted basis 2-3% EBITDA, ARPU growth and margin expansion is what we see. I think more important will be their commentary on how do they go about the tariff hike. I think that's what we are coming to. And I think this quarter will give you a good idea of whether they are looking at a tariff hike in the near term. I think all the three companies will come up and say. And I think this is where the sector is at a juncture where we'll decide that will these the improvement from say FY22 or it's pushed to FY23 or something like that. So this quarter will be more about their commentary on there. I think a 5G spectrum auction will happen sometime by the year end, is what we believe. But the comment by the telcos have been that they are not comfortable with the pricing part. So unless there is a change in the pricing by the government, which there will be because is what we read in the newspaper reports. So I think they will not give any additional inputs to the 5G strategies per se this quarter. So the key monitorable will be their strategy going in. I think we'll also see a first quarter of like to like trend of economy actually fully opening. Okay. So how is the usage of data coming down per serve, or is this the new normal? So this is something that I would also see, because if this is a new normal, you have kind of built on those period, and that is going to translate into higher ARPUs in the future. So that's how I would read this.
Right. Thank you, Bhupendra, for being with us. It was a pleasure speaking. Thank you so much.